my role models growing up used to be Xena, Warrior Princess, and Agent Dana Scully in the X-Files. So that was my worldview.
Yes.
I realized that if I ever wanted to see a brown female protagonist in a game world, I'd probably have to build it myself. Later on, I realized I had to fund it myself as well. So I said, okay, now's the right time, and launched Lumikai in 2020. Terrible year to launch a debut fund. It was COVID, no roadshows possible. Fundraising was on Zoom. There is no other industry in the world that has been able to evoke human emotions and capture human emotions so well other than gaming. What happens in this industry is incredibly acquisitive. 93% of exits in this industry, and you stretch this data back, going back a decade, happen via strategic M&A.
Welcome to the First Cheque Show. I'm super excited about this one. I have with me Salone Sehgal, who is founding partner of Lumikai Fund. Salone, thank you so much for taking out the time to do this. Before I ask you to do a little bit of an intro for us, I want to tell you that there's many firsts on this one. On the First Cheque Show. One of the first is you're our first female guest. Hopefully many more to come. So thank you for that. And also the first time we're doing this with a VC.
Oh, wow. Okay.
Yeah. And I think, this one, we typically bring in founders, but I think you're a founder as well.
Yes.
You've been a founder of a startup, and now you're a founder of a fund. So I have many questions to ask you around those journeys. But thanks for taking out the time.
No, thank you so much for having me.
Let's start with a little bit about your background and journey. I think the part that obviously myself as well as our audience, I think is going to be keen to know about is some of those decisions of investment banking to starting a media gaming business.
Yeah.
And then becoming a VC in that space in India. So give us a little bit of background, but any light you can shed on those transitions, I think would be interesting.
Yeah, sure. I grew up in India, but a large part of my professional career I spent in Europe. I actually spent about 12 years in Europe. I used to play a ton of games. I used to live in fantasy worlds. My role models growing up used to be Xena, Warrior Princess, and Agent Dana Scully in the X-Files. So again, that was my worldview.
Yes.
But my parents were in finance. They were actually both stockbrokers, and they were one of the second publicly listed broking business back in the 1990s, and the first electronic trade on the NSE was actually theirs.
Wow.
So conversations around finance, conversations around investing were very commonplace around, and it was dinner table conversation. So it felt that I would go into finance. But there was always this part of me which loved the world of games. And I think growing up, while playing games, I never saw anybody like me in a gaming world. But I'd fast forward, years later, started my career though in finance. I ended up doing that, kind of trajectory which I'd seen my parents go through. I started with investment banking and private equity, and I ended up, being at Morgan Stanley, being at Barclays. Though I started my career in India, went to the UK, ended up covering the sector in tech, and saw a lot of the rise of markets like China, Israel, Turkey. Got deal exposure, ended up doing about $10 billion of M&A deals. Got completely burnt out after working 100-hour weeks, and decided to leave investment banking with no thought of what I was going to do next. And it so happened that a colleague of mine from business school ended up approaching me for a venture in gaming, and I said, I'm a reluctant entrepreneur, so maybe I'll just consult you and spend a few months. And fast forward, a year later, became CEO and co-founder of the business, and ran a gaming business for 4 years. And I realized that if I ever wanted to see a brown female protagonist in a game world, I'd probably have to build it myself. Later on, I realized I had to fund it myself as well, because I never saw anybody like me on the other side of on the table. And the genesis of that company was that 60% of casual gamers were women. but less than 20% of games and apps were actually built for them. And this was just the emergence of mobile gaming. Mobile gaming was just about taking off. Facebook had launched Farmville and Zynga. That was the years it was taking off. Games as free-to-play businesses were just emerging. Mobile gaming had made games incredibly accessible, but also ubiquitous. You no longer needed very expensive hardware to play games. And there was this mass, I'd say, demographic expansion. And women started playing games, right? And so you had everybody from your grandmoms playing slot games, or you had younger audiences playing those farming games. And it felt like the right time to build this business. And got at that point of time, funding for interactive media or gaming was very hard, even globally.
Yeah.
There was one fund in the world which was investing in games as an asset class. It was a fund called LVP, and it was run by the former CEO of Atari and the former chairman of a company called Unity. And these guys had a tremendous track record, had backed about 50 odd companies, which ended up delivering about $20 billion in shareholder value.
Wow.
And they became, lead investors. Some early team from a company called Supercell became investors, and, had an India-based SKU. But, in any case, over the course of that journey, had to unlearn a lot of things that I learned as a banker about building and operating a business. And it so happened that, eventually when ended up transitioning to join the fund that backed me. So I ended up joining LVP. And ended up seeing the world of what investing looks like from a global lens. And that really exposed me to, meeting a ton of global strategics across Asia, across US, across Europe. And, in 2019 had started to get a lot of deals come from India. But at that point of time, we were raising LVP Fund 3. I was actually, I led it to a first close. And, we didn't want to add India to the fund mandate. So I decided to come back to India. And I said, okay, I'm going to launch my own fund. My partner, now husband, was building a business here. So, I said, okay, now's the right time. And launched Lumikai in 2020. Terrible year to launch a debut fund. It was COVID, no roadshows possible. Fundraising was on Zoom. And then there was China capital prohibition. So you couldn't raise money from Chinese strategics, which are obviously very large and very well capitalized.
Right.
So it was really, I think at that point in time, I was questioning my life choices. But we raised Fund 1. And, fast forward, 5 years later, we have now seen about 3,000 odd deals in the ecosystem. We have a portfolio of 18. We've got, companies like Elo, which is India's largest social entertainment platform. We've got, we hold shares in MPL. We have companies like Autoverse and Framer, which are, So we've backed everything from gaming content, so companies building games, but also platforms. We back tools, tech, infrastructure, and we're also backing companies which are using applied game mechanics to disrupt existing industries like edtech. So that's kind of now.
Wow, you packed the whole thing into the last 3 minutes. I have several questions around different parts of that journey. And can you talk a little bit more about raising capital for a gaming business in 2014? You made it sound like you got one of the best funds in the world that was vertical focused to put money in you, but at that time, I don't think they saw a lot of deal flow from Indian entrepreneurs.
No, not at all. And I was based in UK.
Okay.
So the company was a UK-based company, and I had a team out of UK, and it was a London-based business.
Okay.
It was incredibly hard because also the audience that we were building for was not it was non-traditional at that point of time. And also not a lot of people understood that audience. So in fact, there would be many times I'd walk into a room and they would say, games for women, that's not, like, I play games, but that's not my target audience. And I would find that very astonishing because, I would almost think that if I was, let's say, a blockchain business, you wouldn't necessarily say that, I'm not a blockchain user. You just try and find out more about blockchain and educate yourself. But there were so many investors who just said, female audiences, we don't understand it, but I'm going to ask my wife or my girlfriend to to use this.
Try the product.
And I was like, okay, well, that's great, but you're going to use a sample size of 1 to essentially evaluate my business. Or, there was one time I walked into a room and, this investor walks in and says, oh, a woman running a games business. I didn't expect that. So I was like, well, too bad.
I'm sure you got that
a lot.
Afterwards as well.
Yeah. But I get that a lot even now as a fund manager, right? So I think there were lots of those experiences that one has. But, we landed up in front of LBP at a conference or an event, ended up, getting to know the team very well and the two partners, and just set the chain rolling. And obviously capital raising at that point of time is very different from capital raising now, right?
Of course,
Especially, when I see founders who raise money in 21, 22, who almost think like capital raising is walk into a VC's office and walk out with a term sheet. It was definite, and you've been a founder as well. In those days, I'm sure capital raising was very hard. And now I think we're back in that normal zone to some extent, where you're still building relationships. People are, backing you because they've seen you deliver and execute over a period of time. But that's how it was, but longer lead times. So I don't know about your experience fundraising, but it's always been a challenge.
And then, the transition to then fundraising for a fund, I would say in 2019-20, when you started, there were maybe single digit other vertical focused funds in the country.
Yes.
There were very few.
Yes.
I think you were the first one for media and gaming.
Yes, absolutely.
The first one led by a female founder. And you also mentioned earlier when we were talking that most of your capital is institutional. So how did you do that in COVID? Like sell the vertical. The vertical has a lot of legacy thinking around the absence of, large businesses, real revenue, monetization. So can you unpack that a little for us?
Yeah. It wasn't the easiest pitch, right? India, and I'll tell you, we had three kinds of investors. Those who had never invested in India, those who had invested in India but burnt their hands, and those who had invested in India and seen some success. These were obviously a small minority. But over the decade of being in the industry, had built very strong relationships with global strategics. So, our LP pool is essentially large global, both publicly listed and privately listed companies from Japan, from South Korea, from US, and from Europe. And, of course, having been in the industry in Europe before, they'd seen me. I think they'd kind of built that rapport, built that trust. And for a lot of people, what was exciting was that, we had seen the trajectory of the China market. And I know a lot of VCs don't like to compare India with China.
Sure.
But with respect to when it comes to media and entertainment, interactive media, and the reason why I say interactive media, and, I'll unpack that a little bit, but interactive media globally was becoming more and more mainstream, right? Because you just had this large young population who was just spending all their time on mobile phones. Their experiences that they were demanding were becoming increasingly personalized, increasingly immersive, and increasingly participative, where they wanted agency on their experiences. And this was a phenomenon which was sweeping the world. It was sweeping the US, it was sweeping China, South Korea, Japan. And, India's not a walled garden. And it felt like Indians would not be immune to this trend. And having seen the rise of this in China, Israel, Turkey, and obviously the Western markets, there was an inkling and a hunch to say this will happen to India. And that was essentially the pitch, right? But Fund 1 was very much product market fit for us, right? So when I was doing expectation setting with these LPs, and many of these, relationships were about a decade old, and these were institutional relationships. There was always expectation setting that, okay, look, the market may not be deep enough. So we may see about 100, 200 odd deals. You'll have to be patient. There were always concerns around founder caliber, about depth of the industry, liquidity, and obviously exchange rate, right? Which impacts dollar returns. To some extent, luck and timing, because while for us, fundraising was brutal because it was COVID, but also because it was COVID, media, entertainment, gaming, video consumption really went through the roof.
That's true. Yeah.
And
big
there
step
was
up.
this big jump.
Yeah.
Geo had happened just a couple of years back. Smartphones had become super cheap. You no longer had the same RAM considerations. Memory became, no issue. We saw, 2018, 2019, there was a game called PUBG.
Yeah, of course.
In India, which was being distributed by Tencent at that point of time, which really started to take off because Tencent invested a lot in the local infrastructure, in the streamer influencer network. And those became data points that we started to kind of match to what we were seeing in the other markets, which gave a kernel of conviction and said, okay, that sparked the proverbial fire to say, okay, this is a market where something's definitely going to happen. So, and we should be the fund that should do this. And, if you see the evolution of any venture market, the first wave is always horizontal funds.
Yep.
Because you're solving for basic, utilities like, travel, commerce, fintech, payments, right? The next step is always verticalized funds. And at that point of time, Fireside had existed. Prime Ventures in deep tech had existed. And media and entertainment was a completely wide space. So that was the time, we felt like, hey, this is a market we're going to come in and this is a complete blue ocean. We're going to have to spend a lot of time educating investors. But we had two advantages. One was a global network that I had. And the second was there were now nearly, 75, 80 plus global interactive media funds. And they were very large. And they became downstream capital for us. For our companies, because it's great. I like to say it's important to be early in the market, but not the only. If you're the only, there's a problem.
Yeah.
And thankfully, while we were the only folks in the India market, we were not the only folks in the global market. As a result of which, when we were spotting promising companies, we had downstream capital that we could take those businesses to, and those guys got funded from global capital, especially in the first 2-3 years, which then enabled us to raise Fund 2, and now we're just about closing Fund 2.
But that was also a time, sorry to cut you, that's also a time where a lot of those global investors were looking at the India market,
Absolutely.
right? That's also a phenomenon that we can't take for granted in the entire decade and a half or two.
Yes, absolutely. So timing and also to some extent luck. And, I think about it, had I launched this strategy maybe in 2015, 2016, it would have probably failed.
Yeah.
So yes, timing and luck to a very large extent played a big role in why I'm sitting here today.
And
so.
you said Fund 1 was product market fit.
Yeah.
Product market fit, I'm assuming what you mean by that is from a fundraising perspective.
Also from finding caliber of talent.
Yeah.
And making sure those companies graduated.
So that's what I want to talk about. I want to, to me, those are, I guess if you're able to raise the capital, you've been able to sell the narrative, and you've been able to build conviction around the theme or the thesis. And then the next piece was deploying the capital and seeing the proof in the pudding.
Yeah.
Tell us about that latter part, and when you actually said, okay, this is actually playing out just the way I had projected it to, or better, or, hit it out of the park, which is what it sounds like today when I hear it.
It wasn't like that. I think the first thing was we had to take a very deliberate approach to deal scouting, right? Because we were a new asset class, we were a new entity, right? It was a new franchise. Nobody really knew Lumikai in the market. So, and we couldn't wait for warm intros. VCs love warm intros. That's not the way we operated as a fund. So what we did essentially was, hired a small team, and we started creating I'd say proprietary databases, something that we even follow today, of what we call future founders. So, and I'll give you a little history of why that was important, because in other markets, wherever there's been strong engineering talent or strong telco talent or strong, let's say, back office of gaming companies which have been set up, those have typically been logical hotbeds for founders who then end up building platforms or content companies. Now in India, back in the 2010s, a lot of the larger gaming companies, whether it was Zynga, whether it was Electronic Arts, whether it was Ubisoft, GSN, they all set up shop in India. Now that had already spanned a decade. So there was this talent pool which had been trained on global best practices, who were now running P&Ls between $50 to $100 million, who had that kind of, success stories beneath them to say, hey, we can take companies from zero to scale. We also started seeing the emergence of that first wave of talent who had just built, e-commerce companies or, the likes of social media companies like a ShareChat, etc. Those guys had started to, PMs, etc., was starting to emerge, becoming entrepreneurial. It also coincided with the rise of the entire startup boom. 2020, 21 were, real go-go years.
Yep.
So we started building like this scouting map, and we mapped 300, 400 folks that we called as future founders. And we just started going and talking to them and saying, hey, this is us, we exist. And because we were so entrenched in the ecosystem in terms of, knowing what the pulse in the global markets were, we started brainstorming with them and jamming with them on ideas. And over time, that strategy started to yield results, because then they started becoming founders. That idea germinated, and 6 months later they said, hey, we started messing with a prototype, but this is what I want to build. Or, hey, I actually started ideating on this, and this is what so for example, we backed Ilo, which was a live social streaming platform. They started with social commerce, but we'd seen the emergence of Bilibili in China, right, which was creator-led live streaming platforms taking very popular television formats, converting them into live streams. So you had everything from song, dance, astrology to comedy nights, to audio chat rooms, to player knockout battles being done on a live stream. And we backed them back in 21, and that was a thesis we had because we'd seen some of these similar formats emerge in China. And that's how we started getting our first kind of wave of deal flow come through. Then our next real I think for us, the way we started to add value, and I know value is a very overspoken term in venture, but the way we kind of said, okay, hey, capital is only one of the problems that you're going to face. Because this is a new industry, you're going to need help with hiring. You're going to need help with strategic distribution. You're going to need help with everything from, hey, how do I do user acquisition? How do I do performance marketing? How do I do, anything from, let's say, game design to how do I get my streaming infrastructure to work, right? That's when we would connect, so get some of our LPs involved because they had seen best in class, right? They had seen what worked in global markets and started connecting the dots with the founders, and that helped. And then of course we were working very closely with some of the global funds, whether it was Play Ventures, whether it was Makers Fund, whether it was Courtside, Griffin Gaming, and they came into our companies because they liked what we were doing. That allowed us to graduate these businesses and obviously raise capital. And I think 2 years later, 3 years later, the domestic ecosystem became smarter. Right now, if you look about it, every fund in the country is saying, hey, we want to look at media entertainment, we want to do content bets, we want to do gaming bets. And that also was something where we educated the market, and every year we published a research report. So that research report was essentially an internal document for our LPs, but the numbers were so astounding that we said, okay, people got to see this. And that now research report goes to, the World Economic Forum, it goes to the Indian government. We're now the only VC fund on the Waves subcommittee. IMI uses it, CII uses it, state governments use it. So that really helped to kind of build awareness about this. And I think there was a lot of kind of this laying the foundation step by step. None of it happened overnight. That allowed us to then continue to do this, and it was very hard for us.
And if you look back and you kind of reflect on that 2020 when you did Fund 1 and you started Fund 2 23, like, would you still go down the same path in terms of being vertical focused, or would you take 2 or 3 sectors over, like, more general, like consumer, and then have a media? Because now we see more media and gaming funds coming in that are saying, okay, we're generally consumer, but 30-40% of our allocation will go towards a media and another 30 towards gaming, and then other consumer will be 20. Would you do it differently? Would you do it the same way?
I would do it exactly the same way.
Yeah.
Because I don't know anything else.
Yeah.
So I think that helps. It's like by just sheer elimination, this is the only thing that I know.
Yeah.
And so there's this professional, the Venn diagram between professional interest, personal passion, and just understanding the industry and experience, and kind of fits. And that's all I know. So wouldn't do anything else.
Yeah.
And I think it's great that we have other people who are seeing what we're seeing.
Yeah.
It just means that there is actual value to be created. And, what's very interesting is that in the last 5 years now, we have seen in the portfolio, we've seen 2 exits. We've seen a large gaming company go IPO. We've seen now European strategics acquire Indian assets for north of $700-800 million between Play Simple being sold and Moonfrog being sold. And you've seen VC funds exit through secondaries.
Yeah.
And we did this analysis where for an average holding period of 7 years, median return for early stage investors, because we invested seed, pre-seed, is about 107x. In an asset class which is still yet to see its full potential.
107x
Yeah.
in 7 years.
Yeah.
Which is incredible.
Yeah.
Like, and I think have you benchmarked that to other sectors?
We haven't actually done that analysis, but I'm
Okay.
presuming that it would probably match some of the more incumbent sectors.
Yeah.
Yeah.
Yeah, one would think so.
But actually, it's because these companies become profitable very quickly,
Hmm.
right? You are revenue generating and profitable, right? For example, in Fund 1, 80% of the businesses are revenue generating at seed. In Fund 2, we've done now 7 deals in Fund 2, 6 of them are revenue generating. So if you do it right, you become revenue generating and profitable very quickly.
And that myth around the media and gaming sector, specifically in India, just struggling to monetize, like how were you able to cross that hump with LPs? How were you able to cross that hump? I mean, now there's enough data to show.
Yeah.
So sitting today, June 25, you can quote data from many different sources that validates that. But how did you kind of go through that journey of proving that this will happen? You talked about a hunch in the beginning.
Yeah. So, we did this, we kind of, obviously we didn't have that hardcore monetization data.
Sure.
The couple of things that we did know, and if you look at the China market of 2004 to when gaming was just about taking off in China, right? A couple of things happened at the macro level, right? Digital payments started to take off. So it was 2020. We know what happened with
Mobile
digital
payments,
digital payments. We started in China. There was this youth which entered into the workforce. So a lot of young people. The CCP started pushing make in China games, which is very contrary to the position that they've taken now. A bunch of companies like Giant, Kingsoft, Perfect World went public, and the ecosystem shifted where when instead of importing content, which was contributing to about 70% of their revenue, over the next 3 years or 4 years, 60% of revenue started coming from domestic gaming companies, and that shift happened, and that was a very fast shift. I'm not saying India is going to move that fast, but we could see the early signs there. I think the most important early sign that we could pick up was about real money gaming, right? And again, if we kind of intersperse that with the China experience, real money gaming actually became the first kind of wave where people were starting to spend money on digital platforms, not for utility, but for entertainment. And that kind of laid the seeds for us to say, hey, now we're seeing this behavior. And when we did our research last year, that shift has started to take place. So we mapped real money gamers and free-to-play gamers, and there is a very heavy overlap between the payers in real money gaming. So nearly 66% of payers in real money gaming are also now paying for mid-core content. So they have graduated. So that thesis actually did play out because it has paid out in other markets. King, which built Candy Crush, was actually a skill-based gaming company. Very few people know that. And and Ricardo Zacconi then actually went into free-to-play building mobile games, but actually the genesis came from skill-based gaming. So, having seen that kind of trajectory in the global markets helped to make that pitch to say, look, India's not going to be immune to this. I think the biggest threat to our strategy was the amount of capital Chinese companies were pumping in. So Chinese games were very, very popular in 2020-21. We'd started to see the rise on top grossing titles for these. And then, of course, Chinese apps got banned. And that was another lucky turn of events where Indian platforms, the likes of TikTok, etc., got banned. Chinese games got banned. That was that kind of Cambrian explosion all coming together, which gave a boost to the media entertainment ecosystem, right? So a lot of fortuitous events took place, but and a lot of things had to fall in place for the strategy to work.
Yeah, and maybe switching gears a little bit, the journey of being a founder of a startup to the founder of a fund, like on a personal level, like your time, your energy, you're building a early stage company, you're surrounded by a lot more people. Here you're a little bit of and you started off as a solo GP, or right from the onset you had a partner?
I did have a partner before.
So tell us a little bit about that journey, and then the other question I want to ask about that is that how do you think being an operator has impacted you as being an investor?
I think I've been a founder, now a founder of a fund. I think there's some similarities and some differences. As a founder, you're in control, right? You are all in.
Yeah.
As an investor, you are involved, but you're not really in control. And especially, we're minority investors, let's face it, right? We're not the private equity style where we're taking majority stakes and getting operationally involved in the business, right? As a founder, your feedback loops are incredibly fast, because you get to know what's working, what's not working.
Yeah, hours and days.
Hours and days, right?
Yeah.
And you have direct impact.
Right.
As a VC, your feedback loops are brutal, right? And you have good decisions which lead to bad outcomes, and then you have bad decisions which lead to good outcomes. But you need to have the wisdom to know the difference.
Yeah.
I'd say as a founder, you need to worry about founder market fit. I think as an investor, you need to worry about trust. Market fit. You have to build that brand equity, right? As a founder, you can build culture from day one. As a fund, it can take years, right? Because venture is hard, it's long, people think it's far more glamorous than it actually is.
Yeah, for sure.
And I guess these are kind of the differences. There's another big difference. As a founder, you're always in existential threat, right? Like you feel like your survival is threatened. As an investor, if you do things well, you have continuity or somewhat continuity. Ultimately, I think of VC as a services business, right? On one hand, you serve your LPs with returns. On the other end, you serve your founders
with capital,
and hopefully you help them unlock something that makes their life a little bit easier. But I think as a founder, if you're profitable and successful, you're a master of your own destiny.
Yeah.
As a VC, you're always answerable. Especially if you're managing third-party capital.
Yeah.
If you're not managing you're not building an institutional fund, it's prop capital. Sure, that's very different. But if you're an institutional fund and with the ambition to build an institutional platform, which is very much the mission behind Lumikai, then you're always answerable to somebody else. So I think as a founder, your aim is to always get to that profitability, give your exit, and kind of be independent.
Yeah.
But as a VC, you're committing to a lifetime, I think, of service.
Yeah.
So that is, I think, the big kind of shift, the way I see the big differences between the two. I think, being an operator versus being a founder, look, I've seen some incredibly successful investor VCs. I've also seen some incredibly successful operator VCs.
Yeah.
So I think there's a big debate. Some people say, being an operator is better, being an investor VC is better. I actually don't have an opinion either way. I know what I know, which is that, I know what the long nights feel like. I know what the emotional peaks and troughs feel like. I know business plans are totally useless. And, maybe founders who are going to hear this are going to say, Lumikai doesn't need business plans. That's not true. We still will ask you, but we know that things don't always go to plan.
Yeah. But doesn't mean you don't have one.
Yeah, it doesn't mean you don't have one. At least you know your MIS and your numbers.
Yeah. Right.
But, you kind of know what it feels like. You've walked a mile in the shoes of the founders. I think I also believe that the best investors were the people who gave me very unfiltered, very direct, very raw feedback. I'd rather take direct feedback than the ambiguous, polite board members who general advice, who never really never really catch your blind spots. So I feel like those elements are things that I have as an investor. Hopefully that's appreciated by our founders. We do an annual portfolio survey where we ask our founders to rate us. So our portfolio NPS is north of 80.
Nice.
So I hope that's a good thing.
Yeah, absolutely.
And
what were the things you had to unlearn because when you're, it's like, it's very different. You talked about the feedback loops. You talked about what the value of a business plan or a projection is. But the general DNA is very different, right? As a founder, you're trying to get something to stick and then double down as much as possible. And when you're investing, you're trying to find the needle in the haystack. So how do you, it's a different mindset of glass always half full and, you know, a certain amount of self-confidence or conviction versus, you know, trying to be ringside and find the right boxer to throw in the ring.
I think detachment. You know, that's incredibly hard as an investor. I think there's a
detachment from the businesses.
From the businesses and detachment from outcomes.
But how do you detach from outcomes when you're providing a service to deliver outcomes?
It is incredibly hard. It is incredibly hard because, you know, if you're day to day, you will be, because this is such a long, it's just so long to get liquidity.
Sure.
And, you know, I was in Europe where companies would hit, you know, $3, $4, $5 million run rates in like 18 months, 24 months. That's not what happens in India, right? It takes companies twice as long to hit those numbers. And it's just a much longer cycle of liquidity in India as opposed to the global markets. That was a big lesson actually to unlearn, is from investing in the global markets versus investing in India, right? How long it takes for businesses in India. The second is the delta between knowledge gaps. You know, the global ecosystem, especially in media and entertainment, very closely linked. Whereas for many of these founders who, you know, there's this big delta between what the global guys are doing and what you're building in India, right? Because eventually, especially for half of our portfolio, you're competing with global businesses.
Sure, yeah.
And India's also not a walled garden, right? So if you're a founder who's building an interactive company in India, your user is consuming global best. So your product experience, your product quality has to be at par with global best, but you don't have the resources or the capital to do that. So there was that big delta as well. That was a big unlearning. But also that kind of detachment from outcomes, because this is a 10-year, 20-year journey. If every day your decision is, hey, how do I push this company to deliver my, you know, whatever 5x return, you're going to drive yourself crazy. You're going to drive the founder crazy, right? And that's when your short-term decisions will hamper your long-term returns, because this is a business which only works on compounding.
Yeah, you talked about the journey to where all those things played out. If you were to, I guess two questions. One is that in the market today, are there particular themes or is there a particular thesis that you're scouting for companies or entrepreneurs for? If you can tell us a little bit about that. And then the second one is like, you know, a little bit of the crystal ball. Like if you were to, you started out at the beginning of the decade. Let's talk about maybe 2030. Do we have two decacorns in this vertical coming out of India that are global players, and which ones do you think they might be?
Yeah. Let me answer the first one, right? I'm very excited about the convergence of formats, right? With game mechanics and apps, right? Any successful consumer-facing experience is a game mechanic in disguise. If you think about it, with Instagram, Snapchat, right? They've functioned on what we call the philosophy of dose, right? It's dopamine, oxytocin, serotonin, and endorphins, right? There is no other industry in the world that has been able to evoke human emotions and capture human emotions so well other than gaming, right? So if you're able to, as a consumer app, and you want to capture that holy trinity of engagement, retention, and monetization, you're going to have to use applied game mechanics, especially now with a very young demographic. You know, I call it the swipe before type demographic, who have grown up mobile first, touch first, they're digital natives, and there is a very high degree of personalization, immersion, and participatory nature of their user experience that they expect from you. And this is obviously being reflected in global consumer apps, whether we see a Duolingo, or whether we see a Robinhood, or even closer to home, you see your Cred and you see a Glance AI with their new kind of, you know, fashion AI feature that they've launched. We're seeing more and more of these companies with apps embrace what we call systems of play, which is applied game mechanics. And that's something we've got reflected in our portfolio. So we very recently backed a company called Ask My Guru, which is essentially building, you know, AI avatars of astrologers, so they can be your divine companions 24/7. We have a company called Supernova, which is building AI tutors for learning based outcomes, and with very clear learning based outcomes, but in a gamified manner. We have a company called Autoverse, which is actually an enterprise business. It's monetized completely as a SaaS B2B business, but it's industrial worker safety training for industries like medtech, life sciences, pharma. But they have a game as a sandbox and an R&D lab where they do experiments like multiplayer VR, like rendering of 3D assets, concurrency, which then they port over to their enterprise product. And the experience of their verse builder, which is now it builds VR apps in a few seconds, is incredibly gamified. And it's taken something as boring as very, very technical documentation in pharma, but converted it into VR training programs and modules which are engaging, immersive, with real-time haptic feedback, right? So that is very exciting for us as a business, because that is where I feel the world is also moving to. And crystal ball gazing is, are there decacons out of India? 100%. And they're going to be in the Lumikai portfolio. Completely believe that, and there will be multiple, right? Nobody expected a black myth Wukong to come out of China, right? People always looked at China and said, hey, it's a piracy shop. They'll never build anything original. There'll never be any IP. But if you look at the number of interactive platforms, Pinduoduo, Bilibili, Huya, Douyu, even content-wise, where there's Genshin Impact, etc., all of that emerged, especially in the last, I'd say last 7, 8, 10 years.
And you gave me some stats earlier. 600 million.
590 million gamers, that's right.
590 million
and
gamers,
148 million paying users.
148 million paying users. So that is it really going to happen? It's already happened.
It's already happening.
Like if you,
yeah.
Like 140 million is probably the number of like somewhere there 140, 150 million number of e-commerce shoppers in the country, or maybe it's up to 160, 180 now.
Yeah.
But and so this would be in the top echelon, right?
Yeah, absolutely.
In terms of where users are spending money online in the country.
Yeah, and absolutely, because the value per price proposition is so high, right?
Yeah, and instant.
And it's not intent-led, it's impulse-led, right?
Right.
And when we did research, and every year we do a State of India Gaming, India Interactive Media Research Report, we do it with Google and Deloitte, and we commission a agency to actually run primary surveys, and we also found out that the first time purchasing price of a purchaser is actually 29 rupees. So it's small ticket sizes. And the average revenue per paying user in gaming in India has gone from $2 to $22. But more importantly is the slice of various genres like strategy, casual, etc. They range anywhere from $15 to $22, right? We're seeing subscriptions, virtual gifting, tipping. We're invested in a business called Elo. It's doing about $30 million in run rate, completely virtual gifting and tipping. So all these business models are now taking place in the country. We have another business called DevTouch. These guys are building cricket games for the India market. They see even on in-app advertising, they're seeing eCPMs of nearly $2. Their payback period is 45 days. They get to recover 100% of their money in 45 days, right? So these are businesses which are demonstrating there are theses in motion, actually. So definitely see that reality playing out on the ground.
And so you said definitely from Lumikai portfolio. Which is the first company in the portfolio that you think was public?
Because, well, I just know the history of this industry. It is, you can get very large, very, very valuable outcomes with strategic exits. And, it's a stat.
But enough to support multiple vintages of capital going into
always
the portfolio. Yeah.
Far more sustainable, because in the IPO market, you're always beholden to market timing.
Sure.
Whereas with what happens in this industry is incredibly acquisitive. So, 93% of exits in this industry, and you stretch this data going back a decade, happen via strategic M&A. Simply because there are very large global companies who are very cash flow rich, who are debt free, who have realized it's much easier to buy rather than build it on their own. Because every 2 years there's a new genre, there's a new platform, there's a new content wave, there's a new zeitgeist, there's a new demographic that emerges. It's impossible to keep track of this, right? So actually, majority of our businesses will largely be acquired, and we've already seen that as well. And of course, there will be those 1 or 2 businesses who will go public, and I think those are businesses that we've already see, and we know the founders have ambitions to go public, and that's great. More power to them. But having been on the banking side, I know, and having advised companies on roadshows and IPOs, I know what it takes as well to take businesses public. But then it's very founder dependent, right? It's very, very founder dependent. But, Supercell, for example, which was the company that, previously was backed by the partners of my previous fund, that was a $10 billion exit. Right. And we've seen that over and over again. Like, if you look at some of the deals which have happened, Take-Two, Zynga, you've seen all of those, you've seen, north of, $60 billion worth of strategic exits, right? So I think there is tremendous amount of value to be created. And actually in this sector, value creation happens privately.
Interesting. I was hoping I could get a name out of you, but I think
too much pressure on the founders.
No, I was half kidding with that. But no, thank you so much. This was super insightful. I definitely learned a lot from the conversation, and I'm hoping that between Jungle and Lumikai, we can seed a company together and potentially be part of one of those bigger stories that emerge out of India. But thanks for your time.
Thank you so much for having me.
Thank you for doing this, and look forward to collaborating together with you guys.
Absolutely, really look forward to doing more.
Thank you.
Thank you.